Hey everyone, welcome back. I am so incredibly pumped you're here for this explainer because today we're mastering an incredibly powerful toolkit, short-term business decision making. We're going to strip away all that complex accounting jargon and look at how top-tier managers actually make rapid, highly profitable decisions. By the time we wrap up, you're going to see business data in a completely new, laser-focused way.
But first, I want to pose a slightly provocative question. What if everything you think you know about business costs is just flat out wrong? We often assume that to make a smart financial decision, we've got to factor in every single dollar a company has ever spent. But honestly, that intuition is a total trap. It leads to information overload and, quite frankly, pretty terrible business choices. We need a new framework, a way to filter out the noise and focus strictly on the numbers that actually move the needle.
Okay, let's dive into this. Here is our roadmap for today. 1. Defining relevant business costs. 2. Navigating limiting factors. 3. Make or buy decisions. 4. Dropping unprofitable segments. And finally, 5. Evaluating special orders. Let's hit it.
Section 1. Defining relevant business costs.
Before we tackle any complex business problems, we've got to learn the art of ignoring the noise. So let's start with a concept that is absolutely central to decision-making: opportunity cost. I like to think of this as the ghost of the choice you didn't make. For instance, if you choose to study for an hour, the opportunity cost is the hourly wage you could have earned working instead. It's the potential benefit you give up when you go down one path over another. And here is the critical takeaway. Opportunity cost only applies to scarce resources. If you have unlimited time and unlimited cash, well, opportunity costs don't exist. But in the real world, choosing to use a machine for product A literally means you can't use it for product B. That lost profit from product B, that is a very real, very relevant cost you absolutely have to consider.
Now, on the flip side, we've got sunk costs. These are historic costs that have already been incurred, and because you can't change them no matter what you do in the future, they are completely 100% irrelevant to your current choices. It's exactly like sitting through a terrible movie just because you already bought the ticket. You're never getting that time or money back. Our rule of thumb here is super simple. If it's already spent, ignore it. Whether it's a massive research and development bill from last year or the original book value of a piece of equipment, do not let sunk costs cloud your future-focused decisions.
So the crucial point here is drawing a hard line between these two categories. Relevant costs, they're always in the future, they're cash in nature, and most importantly, they differ between your alternatives. If a cost stays exactly the same no matter what path you pick, it's irrelevant. Irrelevant costs are your sunk costs, past committed costs like an old lease you can't break, and non-cash items like depreciation. Memorize this filter, all right? Because it's going to save you when we hit these upcoming scenarios.
Let's apply this filter to raw materials. Just follow the logic of this decision tree with me. If you need material for a job, your very first question should be, is it in stock? If it's out of stock, easy. Your relevant cost is just whatever the current purchase price is. But what if it is in stock? Well, if you use it regularly, you're going to have to replace it anyway, right? So the relevant cost is still the current purchase price. But if it's not going to be replaced, maybe it's some obsolete material gathering dust, the relevant cost isn't what you originally paid for it. No way, that's a sunk cost. The relevant cost is its opportunity cost. Basically, the scrap value you lose by using it in this project instead of just selling it off.
Let's move on and see how this builds when we look at human resources. This labor decision tree works in a really similar way. The core question here is all about capacity. If your factory has spare capacity, meaning workers are literally sitting idle, the relevant cost of taking on a new job is actually zero. You're already paying them. But if you're maxed out at full capacity, you've got two choices. You either hire more labor, which makes your relevant cost the extra overtime or new staff pay, or if you can't hire more people, you have to pull existing workers away from another project. In that case, your relevant cost is the extra labor cost plus the opportunity cost, which is the lost contribution from that project you just had to pause.
Section 2. Navigating limiting factors.
Now that our toolkit is nice and sharp, let's step into our first boss battle. This happens when a business wants to produce a ton of goods, but a vital resource, like machine hours, skilled labor, or even cash, is heavily restricted. You literally can't do everything, so how do you prioritize? To prevent cognitive overload, we rely on a very rigid 6-step formula. Step 1. Calculate the contribution margin, or CM, per unit for each product. Step 2. Identify how much of the limiting factor, the LF, each unit uses. Step 3 is the magic move. You calculate the contribution margin per unit of the limiting factor. This essentially tells you your bang for your buck. Then, in steps 4, 5, and 6, you rank the products based on that brand new metric, allocate your scarce resources right down the ranking list, and finally, prepare your profit statement.
And this brilliantly illustrates exactly why we have to do that math. We've got 3 products here: Jim, Calf, and Lamb. If you only look at the unit contribution margin, Jim and Calf look like the obvious winners, bringing in $10 each, while Lamb only brings in $7. But wait, we have a limiting factor: labor hours. Jim takes 3 hours, Calf takes a massive 5 hours, but Lamb only takes 1 hour. When we divide that margin by the labor hours, the reality completely flips. Lamb actually generates $7 of profit per labor hour. It is by far the most efficient use of our scarce time, rocketing it straight to the #1 ranking. That is exactly how you maximize profit when your back is against the wall.
Section 3. Make or buy decisions.
Okay, moving on to the classic outsourcing dilemma. Does a business manufacture a component internally in its own factory, or do they just buy it from an external supplier? The rule here is incredibly simple. Choose the cheaper option, but only look at relevant costs. In this differential analysis, we have the cost of making the product internally over on the left. We add up our direct materials, wages, and variable overheads, and we get $262,400. But hold on, if we use our factory space to make this, we're giving up $25,000 in potential rental income. That is an opportunity cost, and it must be added to the cost of making. So total cost to make is $287,400. On the right side, buying it from outside costs $416,000 up front. However, if we buy it, we avoid $50,000 in fixed manufacturing overheads that we would have had to pay otherwise. We subtract that savings from the purchase price, bringing the net cost to buy down to $366,000. When we compare those two totals, we see a massive net saving of $78,600. By choosing to manufacture internally, the company protects its bottom line by this exact amount. Notice how we didn't include general fixed costs that wouldn't change? We strictly focused on what differed.
Section 4. Dropping unprofitable segments.
Next up is a really painful dilemma. Sometimes a department looks like it's just bleeding money and your immediate gut reaction is to shut it down. But as we're learning, the gut reaction is often wrong. Now, what's really interesting about this differential analysis is how it completely exposes the trap of fixed costs. On paper, Department AG looks like a total loser, but look closely at the comparison of the whole company with Dept AG versus without it. If we drop the department, sure, we lose $300,000 in sales and we save $240,000 in variable costs, which means we lose $60,000 in contribution margin. But what about those fixed costs? We only save $40,000 in avoidable fixed costs, things like specific sales salaries. The general administrative fixed costs, those don't just magically disappear, they simply get reallocated to the remaining departments.
And the math reveals a pretty harsh truth. Dropping Department A actually decreases the overall company's net income by $20,000. Even though the department seemed unprofitable in isolation, its positive contribution margin of $60,000 was actually helping absorb the wider company's general fixed costs. Dropping it? That would be a fatal $20,000 mistake.
Section 5. Evaluating special orders. Imagine a customer comes to you wanting a massive, one-time bulk order at a heavily discounted price. Do you take it? Before we look at any numbers, let's lock in the golden rules for special orders. First, only affected costs are relevant, which is usually just your variable costs. Second, ignore fixed manufacturing costs entirely, unless, of course, the special order forces you to go out and rent a special machine just for them. Third, and this is crucial, if you are at full capacity, you absolutely must factor in the opportunity cost of the regular sales you're turning away to fulfill this new order. The ultimate rule, accept the order only if the incremental revenue is greater than the incremental costs.
Let's walk through the math on this one together. The customer is offering a special price of $0.70 per unit. Our prime and variable production overhead cost to make it, $0.65 per unit. So far, it looks like a tiny $0.05 profit, right? Actually, scratch that. It's a loss. Because our regular capacity is totally maxed out, accepting this order forces us to give up regular sales that would have brought in a much higher margin. That foregone contribution is an opportunity cost of $0.26 per unit. So when we subtract our actual variable costs and our opportunity cost from that special $0.70 price, we are left with a unit loss of 0.21. Multiply that by the 2,000 units in the special order, and suddenly we're looking at a total net loss of 420. The incremental costs simply outweigh the revenue. The decision here is crystal clear.
The special order must be firmly rejected.
And that brings us to the end of our explainer. I want to leave you with this final provocative thought. When you sit down at your desk tomorrow, ask yourself, are you making decisions based on the ghosts of the past, those irrelevant sunk costs, or are you focusing entirely on the facts of the future? By mastering relevant costs, limiting factors, and opportunity costs, you transform raw data into strategic profit-maximizing leadership. Thanks for focusing in with me today, and hey, keep making those smart, informed choices.